An Agusto Company's 2023 Nigerian Banking Industry Report underscored the sector's resilience amid macroeconomic and regulatory challenges. The banking industry in Nigeria saw a 27% loan book increase in financial year 2022, attributed to D-CRR activities, higher deposits, and naira devaluation. According to the report, banks fortified growth with risk management and capital raising. It further stated that with normalized cash reserve ratio and forex gains, a 520 basis point return on equity rise to 26.8% is expected. This morning, joining me to break this down, I have Ayokunle Olubunmi, Head of Financial Institutions Ratings, Agusto Company. Thank you so much, Ayokunle, for talking to us this morning.
Thank you. Good morning. Thank you for having me, Lekan.
Now, the report that came out from your firm highlighted the resilience of the Nigerian banking industry despite the challenging macroeconomic conditions. So, kindly talk to us about the key factors that have enabled the industry to maintain its resilience.
Okay, thank you. Like we all know, the 2022 financial year was challenging for businesses, and the banking industry was not left out. If we check the industry, apart from what we have in the macroeconomic headwind, the regulatory headwinds were also very severe, particularly I'm talking about the cash reserve deposit, the arbitrary cash reserve deposit. However, the industry, like we all know, has become relevant and resilient, right? The industry focus more on gaining, disbursing more loans into industry that are relatively more resilient, right? Talking about agriculture, talking about financial institution, and even the telecom industry. And what we even saw in the industry is that the industry also tried to also increase its electronic banking income. This was further supported by the cash reserve, by the cash redesign policy, which increased the volume of electronic banking transactions. We also saw the industry and actually deepening the partnership that they have with fintechs to ensure that the payments app and platform were actually more efficient. Another thing that we saw in the industry last year was the industry trying to look for opportunity outside the traditional core banking activities. I'm talking about the transformation into the holding company. So what the holding company allows banks to do is to diversify their activities into the non-core banking activities, such as PFEs, such as insurance, such as even financial technology, fintech activities, albeit through dedicated subsidiaries.
Between 1999 and 2023, we saw the influx of fintechs and tech-based development finance institutions, and that was one of the things that your report also highlighted, talking about these particular kind of firms coming around to support the Nigerian banking industry. So how do you assess the role of these partnerships in driving innovation, of course, growth in the sector?
Okay, because I think initially when the fintechs actually came about, the banks saw them as competitors. But after now, banks have realized that, look, there are things that the fintechs are more efficient to actually handle relative to the banks. And there are things that the banks can actually handle that the fintechs handle. So what we've seen is like a form of handshake between the banks and the fintechs, right? The fintechs are very good in terms of even developing the payment platform, trying to ensure that the channels are more efficient. So we've seen the banks partnering with them, right? Albeit there are some areas in which they actually actually compete, right? But the things about to do with payments, because the bank have realized that it's difficult for them to maintain the staff, for them to deploy enough resources and ensure that the payment platform are actually working up to date on their own. Because the skill set in the tech community is actually different, right? And the bank, you notice that also, the bank have also been affected by a lot of brainwave, the brain drain that we've actually we've seen over the last couple of years. But the fintechs, given their operations, they can contract some activities out. You see them at times also. They can even have some of their staff working remotely, which is not too fashionable in the banking industry. So we've seen more a collaboration between them, and we're going to see more between the banks and the fintechs, because what we've seen now is that more Nigerians are embracing electronic transfer and transactions, right? And to actually have that, to ensure that those payment platforms are efficient, the banks need to partner more with the fintechs.
So then what about the 27% increase in the industry's loan book for the year 2022? What were the factors responsible that contributed to the increase last year? And did you see a continuing trend this year? And how sustainable is that loan book in terms of repayment or servicing of debt and all that within this economic, financial economic situation that the country is in?
Thank you very much, Lekan. And what we saw last year was that, like I mentioned earlier, a lot of banks have their funds sterilized with the CBN, right, due to the CRR policy, right? And a lot of banks, right, for them to be able to access it, a lot of them focused on what we call the D-CRR window, which is an opportunity to have access to some of your funds sterilized with the CBN, right? Your excess CRR, which is above the regulatory threshold. A lot of banks focused on that. The devaluation to an extent also supported the loan growth. Don't forget also that some banks actually raised capital last year, right? That one also supported the loan growth to an extent. Now, looking at what do we see for 2023, right? The bulk of the loan growth that we have this year will actually be through devaluation. Right. In terms of real growth, the real growth will still be there, but it won't be that significant when we compare it to the level of devaluation. We've seen massive devaluation of the naira, and let's not forget that as at last year, about 42% of the industry's loan book is actually foreign currency denominated. So we notice that the devaluation is going to bloat the loan book a bit further. For the banks that have released their half-year accounts, we've seen a significant jump, especially the big banks, the tier one banks that have a lot of loans to the in foreign currency denominated loans, right? Then also, let's not forget that the devaluation and inflationary pressure has increased the working capital needs of most companies, right? And most companies are realizing that, look, on their own, it's going to be very difficult for them to fund that particular increase. And that is why a lot of them are deferring to the banks. Now, another thing that will contribute to the loan growth this year is that we've had successful transition, because in the first half of the year, right, even towards last year, a lot of banks were actually a bit cautious because they don't know the direction of the election. But now we have a president in place. We already know the economic direction, and a lot of banks are now key. These are where the opportunities are. These are the risks, and they are actually trying to even manage it. Talking about the ability of customers to repay, we all know what is happening, and it's actually exerted severe pressure on the cash flow of customers, right? Of course, definitely we expect there to actually be an increase in the volume of impairment loans, right? And although, right, we believe that the NPL will increase from 3.3% that we have now to about 4% by the end of 2023. But we think that it will still be below the regulatory threshold. Because something that we saw last year, that a lot of banks severely work on their non-performing loan last year. A lot of them did write-offs. Some were more aggressive in the recovery. But this year, we believe that the severe pressure that we are having in the macroeconomic environment will also impair the ability of more customers to repay, and we see a rise in the NPL rate.
Let's now look at the recent reforms implemented by this current administration. We talk about the removal of the petrol subsidy and, of course, the exchange rate harmonization that actually led to the floating of the naira. As at the time the government was coming out with those policies, what were your expectations? What were you expecting to change? What impact were you hoping for? And how is it playing out now, looking at the opportunities that we have or we could have had in the banking industry?
Yes. And in terms of the harmonization of the foreign exchange, by now a lot of us thought that the volatility that we have in the markets will have actually even settled. Right. Unfortunately for us, remember that a lot of us didn't have access to the financial statements of the CBN, right? The true state of the external reserve was not known to a lot of people, right? And even we also expected, the expectation then was that the cabinet will actually be in place before now, right? And things will have actually even been flowing, right? However, right, it's taking longer than expected, right? And then also there are a lot of concerns about the reserves. A lot of us didn't know that the level of borrowings, the level of encumbered portion of the reserve is going to be this high, right? But for now, we think it's a long walk, right? Before the end of, we believe that by Q1 2024, right, there should be a bit more stability in the foreign exchange market, and then it should be trading at the real value of the naira, because of course everybody know that. Of course, the real value of the naira is not 900; it's way over. It's actually very high, right? Higher than what it should actually be. In terms of the regulation of the downstream sector, a lot of us were expecting that there will be a gradual phase out of the subsidy, but the president took the full sweep of even removing it, right? And what we've seen is that one has, on one hand, it has inflationary pressure that have affected the OPEX of banks. But on the other side, you notice that it has also created opportunities for banks to actually support that particular industry. Because now the fundamentals are relatively better, right? And even now it gives opportunity to even shift to actually even decipher the serious players and those that are just posting along in the industry. And what this one has also shown is that you've also seen that the cost of even getting a trailer, a tanker load of fuel has dropped significantly by almost 300%. So that creates lending opportunities for the banking industry. And almost all the banks are trying to look at that particular sector very well to see where they can. A lot of them are positioning themselves to support and even lend them. But like we all know, right, know that we're still having some concern with subsidy come in one form or the other. All those ones, the clarity is not that much in that particular space. But a lot of banks are seeing the opportunity in that downstream sector to actually go back to.
All right, let's just stay with the talk about opportunities that could have come to the banking industry. Now, there is a postulation that the eradication of the arbitrary cash reserve ratio debits is expected to boost liquidity and loan book growth. So I'd like you to first take us back to what the situation used to be and its attendant impact. Then you now explain how banks might leverage this opportunity to manage associated risks.
Okay. Around 2020, right, the CBN introduced what they call the arbitrary cash reserve ratio. Before, of course, you have the normal CRR, but the situation that we had from 2020 is that you can wake up one day and the bulk of your funds are actually taken by the CBN as CRR. So for a lot of banks, it was a lot of headache. A lot of banks find it difficult to actually even plan accordingly, right? And it got to a point that there are some banks, they have up to 120% of their local currency deposits stellar with the CBN. You agree with me that is actually a very big headache for the banks, because most banks will tell you that they don't even mind if the CRR is 60%, but at least you have something that you can actually even plan with. So it was a good news to the banks when the CBN announced in June that they're going to revert to the methodological computation of the CRR, right? So meaning that you know that this is what I have. But the CBN also gave a caveat that if you don't meet the LDR policy, you're going to actually even have, right, your some additional cash reserve debits. And what we've seen is that a lot of banks have actually grown on the back of that. They can actually go now and even get more deposits. You are not scared that it will be held sterile by the CBN. If you look at last year, comparing the liquidity ratio of the banking industry, comparing what we had last year to what we had before, it dropped significantly. Right, but for now, with those funds actually even coming in, it will support more opportunities for bank, more loan growth opportunities for bank. The liquidity position of that part of the industry is also going to be better. Then banks also have opportunity to even trade more resources to actually even trade in it. And the benefits will be more pronounced in the merchant banking space. Like we know in the merchant banking space, right, what they do, they rely primarily on wholesale deposits. Right, and that's why we notice that that before 2020, right, they always have very low cash reserve ratio, right? I think before it was 2%, until it was removed, it was jacked up to like 27%, but now it has been reduced to 10%. We're going to see a significant impact in the merchant banking industry, and that will boost the liquidity of bank. Let's also not forget that with the removal of subsidy, there's more money that is being shared among all the tiers of government, and all those funds will also flow into the banking industry. So the liquidity position of the industry will increase, right? The banks can actually do their financial intermediation activities. They can do it well now, right? And that will also result into better performance by the year 2023.
Let's still refer to the reports. Now, there's a projection that a positive performance of the Nigerian banking industry would be seen. Now, how positive are you in terms of the performance that we are likely to see looking at now into probably the end of this quarter and the next quarter? So how do you see it? Do you see this resilience continuing? Are there some areas that you feel that the banking industry will still need to key into to be able to buff up this strength, whether or not there are other unforeseen economic shocks?
Okay. From even the half-year result that we've seen a significant growth in the performance of the banking industry, and it's going to be massive in 2023, right? Because the massive devaluation that we have, remember that a lot of banks, because everybody was expecting this devaluation, so almost all the banks have a net foreign currency position, foreign currency asset position, right? When it gets a foreign currency balance, they have more asset than liabilities. So a lot of them are going to record significant revaluation gains. Don't also forget, remember I told you that about 49% of the industry's loan book was actually in foreign currency. So the income that they have on this particular asset that is in foreign currency, the naira value will be more bloated. So it's going to actually even affect, it's going to support the industry. And then let's forget what I said earlier. With more liquidity, more funds have more funds that they can actually play around with. Having said that, there are also some pinpoints that the industry, some things that we moderate this level of performance. First is the impairment charge, right? Because like what we've seen, the macro is getting riskier, the environment is getting more difficult. So of course, you notice that the impairment charge the banks will take is going to be more. Inflationary pressure is also much. Don't forget also that some of the cost of the banking industry is also foreign currency denominated. We spoke earlier about what they are doing on the electronic banking channels. A lot of those equipments and some of those costs are denominated in dollars. So that will also increase it. If you've also noticed, you notice that a lot of banks are increasing the staff salary. Some of them are even doubling it. That will also increase the operating expense of the banking industry. Then having said that also, a lot of banks are also realizing that with the increased risk we're having in the environment, there's also a need to further buffer of the capital. And if you've been looking at the market, you notice that a lot of banks have already disclosed capital raising plans. Some of them either through rights issue, through private placements. Some of them are even doing subordinated bonds, and some are even looking at issuing perpetual bonds that will classify as additional tier 1 capital. So we expect to see a significant increase in capital raising activities, right? Up from Q3, Q4, and even going up to Q1 2024 to increase the buffer of the banks and their ability to take on more risk.
Okay, thank you so much. Ayokunle Olubunmi, Head Financial Institutions Ratings, Agusto and Company. Thank you so much for talking to us at this time.
Thank you for having me.